So, it feels just like yesterday that hhis was launched at the start of this year. We're now already halfway through the year, and finally had the final inclusion of 15 holdings in the ETF with Apple being included. I don't think we've seen the popularity of a new ETF grow as fast as hhis since HYLD, and has definitely been warranted so far. In just the 5 months since inception, it has reached almost half of HYLD's AUM and is continuing to steadily grow every week. If you're not already familiar with hhis and the details yet, feel free to watch a previous video after this one to get to know how it specifically works. I also want to take the time to quickly thank Bill, who is a subscriber, and originally helped inspire the creation of the dashboard I'll be using in this video for the comparisons. And finally, consider subscribing to help out the channel if you haven't yet. These videos take a long time to make, and it would really help the channel grow with your support. We're halfway through the year, and there are 6 months left to reach my goal of 2,000 subscribers. Thanks in advance, and now let's get into the performance so far of all these ETFs. So to start, I'll quickly go over how this dashboard is set up so you can easily follow along. There are 3 sections here, and the first one is for the underlying stocks. The next one below are all 15 of the Harvest High Income Shares ETFs. Then at the bottom is hhis by itself in comparison to the Nasdaq index with QQC. Now going back to the first section, the logos are used to quickly distinguish each underlying stock. Then beneath that are the starting dates being used individually for each column. These are organized so that the corresponding Harvest ETFs are directly below, so that is how you want to be looking at the numbers between the 2 sections. Now below the dates are the tickers, current stock price, and then the day's change in price. After that, we have the total amount of dividends that have been paid out since the start date above. This value gets automatically updated on the ex-dividend date, so that the total return value in the box below remains as accurate as possible. With that out of the way, for context, this is being recorded on June 10th after the market close. And to show proof for these numbers and how accurate they are, I'll showcase it with the first 2 ETFs here by removing the dividend values from each one. Starting with MSHE, the current total return starting from the beginning of the year is 4.41% with the dividends included. If I were now to delete the 80 cents as been paid out, then that would bring it down to negative 2.25% in total return. What this is now showing without the dividends being included is the price return, which means that we can use Google to verify this. With the chart, we can now go to see the year-to-date price performance. And as you can see, it is now showing a negative 2.25% price return year-to-date, just like it does on the spreadsheet. Now, if we do this again with AMHE, by removing the dividends, the total return drops to negative 13.17%. Checking on Google and selecting the year-to-date selection again, we see that this matches as well. So with all that verified, we can now begin to look at each comparison to see how they perform so far. Here, we'll first start with an overview of all the ETFs together on some charts. To the left, we have all of them shown on the same chart for the year-to-date total return. I've also added the unhedged and hedged versions of the S&P 500 index to these charts. Since the S&P 500 index is the most popular and common index to compare to, I thought I'd include it here as a performance gauge. Why it's also great by having both of them shown here is that it also shows us the relative impact of currency hedging. This is because both of these are invested in the index, and the only difference between them is the currency hedging aspect. So if we just take the difference between the two, we see that it's created a 4.41% gap. We don't have any Canadian dollar hedged ETFs on this chart, but if we did, then it would have outperformed an unhedged version by approximately 4.41%. Then for the actual ETFs, there's a caveat that goes into reading this chart, and that's because these were released in different batches this year. So because this chart is just showing the values starting from the beginning of this year, some of these may look better or worse than others, depending on their inception dates. But in general, it's pretty clear on the chart that Palantir is the best performer of them all so far. And it should be to no surprise that Tesla is the worst performing one, due to all the political news and drama. Going over to the other chart now, I won't go into too much detail, but it shows the 52-week high and low for the indexes along with all the Harvest ETFs. The reason for skimming over this is similar to the previous chart, because it hasn't been a full 52 weeks yet for any of these ETFs. So you can't accurately say whether or not they're actually at their highs or lows in order to look for potential buying opportunities. Now let's get back to the main dashboard for some more detailed comparisons. Because all these ETFs were released at different times, I'll quickly go through each one of them and give some thoughts. The first group was released on August 22nd, and it consisted of Microsoft, Amazon, Eli Lilly, and Nvidia. The rest of these you'll see update to say invalid date, and that's because they were not released yet, so there is no data available. One more thing to note is that although Harvest ETFs are unhedged, there's still some currency impact that can influence actual total returns because of the stock prices being in different currencies. Now starting with Microsoft, we see the total returns for MSFT coming in at 13.92%, while MSHE is at 12.27%. This is quite close considering it's been just over 9 months since the inception date, and this also includes the Liberation Day market crash. For Amazon, the total returns are 23.55%, while AMHE is at 23.88%. So for this one, the covered call ETF is actually out ahead by a very slight margin since inception. Then for Eli Lilly, we see the underlying at negative 14.95%, and then the covered call ETF down by negative 17.66%. If we look at the stock chart, this ETF literally launched at the 52-week highs before declining to where it is now. And finally for Nvidia, we have the underlying stock at 16.36%, while NVHE is at 10.92%. This does make sense because of how volatile Nvidia can react to market news. And because of this volatility, it's why it receives higher options premiums when it comes to covered calls, and is able to pay a higher yield than the others. In general, the less volatile a stock is, the chances of underperformance or degree of underperformance is narrower. But with less volatility, it also means a lower yield, so it's a trade-off you have to consider when deciding to invest in one of these single stock ETFs. The next comparison will be for the second batch of ETFs released on January 16th. This group will include Tesla, Palantir, Meta, and everyone's favorite, hhis. For the initial group of 4, it looks like if you had purchased them starting from January 16th until today, there would be a larger discrepancy in performance. I can't exactly pinpoint why this is the case, but I would just have to say that performances of these ETFs will vary depending on your own investing and timing. So in this case, you might have bought the highs before the market started dropping due to all the tariff news. Then among the new single stock ETFs, Tesla saw quite the decline, and timing wise again would not have been great. Investing in Tesla has definitely not been for the faint of heart these past few months, and is probably not going to change anytime soon. On the other hand, for Palantir, it would have been the most amazing time to get in, because the stock soared after the earnings release, and you would be up 80% today. You would have been up by 91.81% if you had owned the underlying stock, but you would have been paid $1.92 in dividends with PLTE. Palantir is definitely one of the more volatile stocks out there, and this is just one of the trade-offs with the covered call strategy. This is also just 5 months of performance, so things could change, but you can't really complain about an 80% return in such a short time period. Then with Meta, there would be an approximate 10% underperformance if you had invested since inception. It may seem like a lot, but let's keep going and see if it improves if you invested at a different time period. Before I forget, we also have to talk about hhis at the bottom section here. If you had invested into hhis on the inception date, you would now be up by 3.07% in total return. While QQC, which is the unhedged Nasdaq index, would actually be down right now by negative 0.97% in total return. That's a difference of 4.04%, which is quite significant and something definitely to be happy about as a hhis shareholder. Okay, now let's see how the performance would be if you had started investing in these on the inception of the third batch of ETFs. So these were actually launched on March 5th, but Google Finance doesn't have the data available for all of them, so we'll have to start on March 6th for these comparisons. Now keep in mind that this will only be over the course of a 3-month period, so it's a very small sample size. For this group, I'm not going to spend the time going through each one individually because there's a lot. But in short, all of the underlying stocks have outperformed the covered call ETFs in varying degrees. Feel free to pause here and take a closer look for yourself, but what I'd actually like to point out is hhis's performance over the same time period. When compared to QQC, it has greatly outperformed it by approximately 9.61%. So while we can see that the covered call ETFs have all underperformed their underlying stocks over this time period, we have hhis, which holds all these same ETFs, but with a big outperformance of the index. And why this is the case is because if I highlight all the ETFs that have outperformed the index, you'll see that it's actually 9 out of the 14 ETFs. The remaining ones are all down for their own specific reasons, or have also performed quite close to the index as well. I know in general, everyone compares the performance of these to their underlying stocks, and this is what this dashboard here is mostly doing as well. But a comparison to the index is also another way to look at things, and is also very valid when it comes to measuring performance. Take for example Palantir. Yes, you would have underperformed the underlying stock by 2.13% over this period, but you would have outperformed QQC by 58.19%. So the question is if that potential trade-off for performance is worth the benefits of receiving a high monthly income and the other benefits of a covered call strategy. In general, many of these single stock ETFs are with very volatile stocks, which is why they're able to receive those higher options premiums. So that means it comes with a high potential of being capped, or to some degree of underperformance when it comes to comparing it to just holding the underlying stock itself. That's just one of the things you have to determine for yourself and acknowledge when investing in these more volatile single stock ETFs. If performance compared to the underlying is important to you, then I'd probably recommend sticking to the index-based ones like USCL, HYLD, and QQCL. Those will not yield as high as some of these single stock ETFs, but they have shown to keep up or even beat the indexes depending on the market conditions. You have to also keep in mind that all these values are likely not reflective of the real returns an investor would actually see if he had invested in either the underlying stocks or the covered call ETFs. And this is because all these total return values are based on a single lump sum investment and without any future purchases. This is not accurate or the case for most if not all investors, as many of us will continue to add to a position over time and therefore reduce the total return value. A simple example of this is if we had one share of a $10 stock. The stock price then increases to $11, which is equivalent to a 10% gain or a 10% total return. If we then buy an additional share at $11, then our new invested amount is equal to $21, and the total value of the 2 shares is $22. We can put these values into a formula to calculate for total returns, and we get 22 minus 21 divided by 21. This would then be equal to 1 divided by 21, and would result in a total return of 4.76%. So you can see how quickly this can drop depending on the amounts you personally invest, and how unlikely it is you'll see the same values shown here in these comparisons, unless you never purchase additional shares aside from your initial investment. There's a lot more I can probably add, but these are just some perspectives to be aware of that I thought should be brought up. Next, I thought it would be worthwhile to also see a performance comparison of how these have performed through the recovery since the Liberation Day tariffs. Because being capped in the upside is what we need to avoid with the cover call strategy, and this would be a good example to show how badly these would underperform in this circumstance. So if we now change the date to April 8th, we can see the total returns from when the markets were at the very bottom until today. As you can see, it's actually not all that bad, and actually very surprising given the expectation is for all of them to greatly underperform. Many of these are within a 5% or less difference with the underlying stock, and we have a few cover call ETFs that have actually outperformed the underlying stock itself. With regards to hhis, it's actually nearly double the returns of the index, with a 40.27% total return over this time period. Then, if I now highlight all the harvest ETFs that have a total return greater than the index, we have 11 out of 14 of them showing an outperformance. So again, if you compare it to the underlying stock, you may have underperformed slightly, but some of these have doubled or even tripled the returns of the index itself. Now, many are going to point to April 9th, being the day where all these ETFs would have been capped, because of how high the market soared that day. This was the day that Trump issued a pause on tariffs, and all the indexes ended up posting historic record numbers for a single day gain. The S&P 500 index itself had the third biggest one-day gain since World War II with 9.52%. As for the Nasdaq, it had the second biggest gain on record with 12.16%. So seeing all these numbers, you would think that all the cover call ETFs must have been capped on that day for sure, right? Well, that actually didn't look to be the case, and I have a snapshot of that day to show you exactly how these performed. If I highlight just a change in price for both sections to compare, you'll see that nearly all of them actually perform on par or even end up going higher than the underlying stocks. The only 2 ETFs that look to have been likely capped would have been Broadcom and Costco. And because of these big gains in the underlying ETFs, hhis also saw a 16.36% gain compared to QQQ's 12% gain. I was actually still using QQQ at this point in time for comparison, which is actually the USD version of the Nasdaq index. So hhis would have actually outperformed by an even greater amount if I had used QQC instead. All in all, the fund managers at Harvest did a great job with capturing most or even more of the upside on this single historic day for many of these ETFs. So this was a fairly in-depth look at the performance through various periods, depending on when you had invested into these ETFs. Hopefully it was helpful in showing how these have performed so far, and have given some insight into the performance you can expect when investing in them. Again, this is only through a short period of less than a year or even half a year, but we'll just have to see how these will continue to perform in the future. So if you would like to see another one of these reviews, feel free to like and subscribe for future videos. What you can do to let me know if you want to keep seeing more in the future is to like them, because that shows to me that there is an interest. And as a thank you for the support so far, I'll also be posting a public version of the dashboard shown in this video so you can follow along for yourself. It'll be linked in the video description below, and by default it'll show you the performance of each ETF since its inception. But if you want a more exclusive version where you can make changes to see comparisons from different dates, I'll actually be including this into a new Patreon tier that I'll be announcing now, and that is for the Canadian cover call ETF dashboards. This is something I've been working on for a while now, and I've tried to make it as useful as possible for all investors who are starting out or have a keen interest in tracking performance like I do. The purpose of this is because I've seen many people comparing ETFs incorrectly, or not accounting for the impact currency hedging can make when it comes to performance. So to help fix this, I've done all the research and put many of the currently available cover call ETFs onto individual dashboards, where you can easily compare them more accurately. In total, there are over 245 ETFs or stocks being used in these comparisons, and over 125 of them are cover call ETFs spread across 21 individual dashboards. They are first organized by whether they are currency hedged or unhedged, and then by the specific strategies such as growth, leverage growth, cover calls, and leverage cover calls. I've also included a Yield Max ETF dashboard as well, because I know many of us invest in them for their high monthly yields. All of these are live data, meaning they will automatically update every 15 to 20 minutes, so you can watch it throughout the day when the market is open if you like. There are dashboards for most of the major sectors or industries so far, but there are still some others I can still add to the collection in the future. And that is one of the main reasons why this will come in the form of a small subscription, because it is something I'll continue to add and make changes to when there are new ETF releases, or feature updates to help improve the experience. I'd like for this to be a useful tool where you can do research and easily monitor total return performance in order to grow your portfolios. Not all covered call products are the same, and there are definitely some better than others. So if you don't track or are not aware what other products are out there, you could be missing out on potential gains. And as you can probably see by now, I might be a little bit too obsessed with spreadsheets. So with the subscription, I'll also be potentially offering to build other types of spreadsheets as well for analysis, based on the interest from the private Discord community that is also included. There's so many other lists, cheat sheets, calculators, and other things that can be interesting to build, and those will automatically be included as part of the subscription as well. So because I like for this to be widely available to as many people as possible, the subscription is going to be $3 a month, or if you divide by 30 days, it would be 10 cents a day. It'll also help in continuing to support the channel, so I can keep making quality content for everyone. Depending on the demand or interest from everyone, there could be some delays, so please be patient if an issue does come up. So before we wrap up, here's just a quick summary of all the features and how to use it if you end up becoming a member. For many of the dashboards, when you open it for the first time, you'll be shown some charts, and then the details of each individual ETF used in the comparisons. We've already gone through a little bit of this earlier, but on the first chart is where you can easily see the differences between the currency hedged and the unhedged ETFs. Because of the Canadian dollar outperforming the US dollar, it's easy to see here that all the currency hedged ETFs are in the green, and then all the unhedged ones are in the red. This can also be seen in the chart on the right as well, where all the currency hedged ETFs are closer to 52-week highs, whereas the unhedged ones are further away. Then, directly below each chart is a commentary section, where I'll look to add some insights based on what the charts are showing at the time. It's not meant to be investment advice, but it's just to give you some context when looking at the charts. Then in the section below, I've added individual cards for each ETF in the spreadsheet, where you can have all the basic information and understand what the actual differences between the ETFs are. You can find the ETF name, ticker, current price, a 1-year sparkline, and then all the current dividend information. Then there's a small description of the ETF from the fund's website, other information such as fees, leverage, and cover call details. I've also added another metric for fun, where it shows you how much a $1,000 investment would earn you per year. You shouldn't be investing in a product solely based on this, but it's to give you an idea of what you can expect if everything stays the same. And finally, this is probably the most important part, and that's the specific holdings of each of these ETFs. I spent a lot of time trying to vet these comparisons to make sure all the underlying holdings are actually reasonable to be compared to one another. Sometimes one ETF may outperform another, but if the underlying holdings are not even remotely the same, then it's not really a fair comparison to begin with. So if you don't see a specific ETF listed for a sector, it could be because it's too different to be compared to the others, and was probably added to another sheet with ETFs that are more reasonable. Okay, now for the actual dashboard itself. When you're here, you'll have the ability to only change the dates for each section. There are two ways to change a date, and you can either type it in manually, or double click the cell to open up a calendar. For the calendar, it's pretty straightforward, where you just select the date you want to start from, and then it'll automatically update the sheet. When typing in the date, you'll want to type in the same format as you currently see right now, and that would be the first 3 letters of the month, the date, and then the year. This way you don't confuse Google Sheets or end up changing the formatting, because it can be a bit finicky. If you type it in wrong or mess it up, just use the undo button in the toolbar above to fix it. Now, you'll notice every time you change a date value, you'll see that the start date for all the ETFs changed to red. This is to let you know that it's processing your change, and when it turns back to normal, it means your values have now been updated. So when you see it turn red, just give it a little bit of time to process and update all the values. If you happen to select a date and see invalid date under the total return, that could mean one of two things. First, it could mean that you selected a date before that particular ETF's inception date, or it could mean that Google doesn't have that data available on that specific date. This is where you want to hover over the little triangle on the ETF start date to see when the ETF was actually started and when the data from Google should be available. So if we now go back to the date and change it to the data start date from the note, you'll see that there is now a value for the total return. Most of the time, if you input a date after the data start date, it should provide a return, but there are some instances where you can still see the invalid date. And that's just because for some reason, Google might not have the data for that particular day on that ETF. So you just have to try another date until you find one that works. If you don't want to guess, you can just go to Google itself and pull up the chart to see exactly which dates are available by hovering over the chart. Alright, so that should cover all the details and give you a glimpse into what it is you'll get with each of the dashboards in the membership. If you want to sign up and start using the dashboards, follow the Patreon link in the description below. Otherwise, thanks for watching and I'll see you in the next video.